Hello, everybody. Hopefully you can hear me. My name is Salvatore Cantale, and I'm a professor of finance, and I'm going to be really, really happy to actually moderating this session. As you might have seen, we do have lots of different speakers today. So we're going to be basically talking and being very, very quick. I have like this fantastic task of introducing all these different people, but also this horrible task to make sure that the people actually being here are going to be on time. So I'll make sure that this is going to be happening. Let me introduce directly the first two guests of our talk. Is Jean-Pierre Dantin, is Managing Director of E4S, is a professor at EPFL, and he was the one who was working at the Swiss National Bank. He's going to be talking with Florence Haggart, who is a research scientific collaborator at E4S. So without further ado, please start.
Okay, thank you, Salvatore. We have a lot to do, so I'll be brief. I want to welcome you to this event. I'm very pleased to see so many of you attending this session. I am welcoming you on behalf of E4S, if that works. Nope. Okay. On behalf of E4S, which is a joint venture between IMD, APFL, and the University of Lausanne, so in an academic venture. We have the prospect, we have the ambition to inspire and activate the change to, here we are, no, not yet. Okay, here we are. So we have the ambition to activate and inspire the transition to a resilient and inclusive economy within planetary boundaries, mindful of the opportunities and challenges raised by scientific and technological change. And obviously, if we want to do that, the notion of energy is a natural focus. It's not our only focus, but it's a natural focus, in particular, because in the domain of energy, we have most of the solution, not all of them, but we have many solutions. And what we need to do is make sure that we implement these solutions in time, accelerate. And that's where finance has a key role to play, and we will be illustrating a few directions in which this could be happening. We can do it. We have been working on this topic at E4S, and indeed today we are launching a new report. It's called the Swiss Market of Green Bonds, Breaking Down the Barriers to Scale. So still we're very much in this spirit. Breaking down the barrier to scale, and in the QR code that you have there, you have access to a number of our work, of our white papers on the topic of finance and the topic of energy transition. Schumpeter used to say, bankers, and I think he meant financier investors, are the gatekeepers of capitalist economic development. And that's what we need to be doing now, very quickly accelerating. Gatekeepers in a very positive sense. We need to filter, we need to orient, we need to guide, we need to stimulate, we need to accelerate. Thank you for your attention. Florence will present a number of work that we have been doing on the topic.
Thank you, Jean-Pierre, and good morning, everyone. I'm very pleased to be here with you all today and with the amazing speakers that will be joining us later on stage. Before I start, I wanted to mention that we have a Slido. So during the different talks, there will be some interaction with the public, so you can already scan this code, and then you will be able to answer the question then. But the code will be coming back, of course. Okay, so here. All right. So, over the next couple of minutes, I would like to set the scene for this event and highlight a little bit what we can do as financial professionals to enable the energy transition. So, greenhouse gas emission, so 2/3 of greenhouse gas emissions today are emitted through the energy sector. And as you can see here in dark shades of red, most of these emissions come from transport, energy in buildings, and energy in the industry. The good news is that there are solutions to decarbonate those subsectors. And the scale of these solutions depends on many different actors. Firms across the entire value chain, policy, consumers, but also the financial sector. And so the financial sector can enable this transition through three main levers of action. The first one is financing, especially financing the transition, the firms that are enabling this transition and firms that are transitioning credibly. According to the International Energy Agency, total investment in clean energy, which amounted to $1.4 trillion in 2022, so which is the first bar on this first chart, well, these investments would need to triple by 2030 if we want to meet the net zero goal by 2050. And this is the last bar of this chart. Now, capital needs to be redirected towards clean energy firms, and that includes clean tech energy firms, but also small and medium-sized energy infrastructure projects. We also see that capital needs to increase in level, and in particular also in the private sector, that you can see on the second chart. The role of the public financing is also very important, in particular in emerging markets, because public financing can help boost the development of new infrastructure, accelerate innovation, but also de-risk projects to mobilize additional private capital. Finally, investment should also be steered toward firms that are transitioning credibly, and new forms of financing that include sustainability components such as green bonds or sustainability-linked bonds can accompany these firms in their transition. So this is the first lever. Now, the second one that financial professionals can use is engagement with firms that are not yet committed to the transition. And they can do so in various ways and focus on specific topics when we talk about the energy transition. The first one would be to ask for the company to disclose more on more climate-related information, on setting credible emission reduction targets, but also on how it thinks about implementing the climate strategy it sets and how governance practices align with this climate strategy. Finally, if engagement doesn't work, the third lever that a financial professional can use is divestment in last resort. So certain firms simply cannot transition or are not willing to transition or simply are not answering to engagement efforts. And so divestment in that case can have an impact on those firms through three different channels. The first one is capital rationing on primary markets. The second one can produce a negative shock on stock prices on secondary markets. And finally, it can also strengthen the stigma around the firm. Divestment has been shown to be particularly efficient on primary markets, and in particular in bank exit policies on coal. There is a recent study that showed that firms that were targeted by those policies were actually more likely to retire coal power plants than other firms. So, as you can see, there is a variety of ways through which the financial industry can enable this transition, but still some challenges persist, and this session today will highlight some of those challenges and will also present two solutions that can address those challenges. Those two solutions are Servetia and Frigg. And so with that, I thank you for your attention, and I wish you an insightful event. Thank you.
Thank you so much, Florence. Thank you so much, Jean-Pierre, for this insightful introduction and motivation to the session. Thank you so much. And now we go to the next stage. I would like to call over here Alexander von Almen and Ian Eberhardt, please. Oh, you're here. Alexander is head of portfolio management at Retraite Populaire, and Ian is in the sustainability group lead at Pictet. Let's start with you, and I'm sure I have questions for you. So maybe can I start with you, Alex? Okay, Alex. From your point of view, what are the challenges for financing the green transition?
So, challenges, there are several challenges. Maybe first is our mandate. Our primary mandate is not to finance actually the energy transition. It's to achieve a required return. So that's the first one. Second, I think, is time horizon, and this is especially true for probably listed investments. A lot of these things that we've seen until now are long-term investments, so they require a long-term investment horizon, which may sound easy and trivial for insurance company and pension funds, but in practice it's not always. It also requires that the willingness to deviate in terms of performance from peers and maybe from the broader market. And then lastly, I would mention maybe would also be the pace. So be careful of, in my seat, be careful of green bubbles, green assets bubbles. So we've heard a lot of money must flow, but it can also be too much from an investment perspective.
Absolutely. So let me just come back to you. Clients, customers, do they ask for that or not?
So,
in your experience, obviously.
I would say today clients, they ask in a shy manner for it. So we don't get huge demand from clients or huge pressure. There, of course, we get incentivized and we get pressure from several groups to invest more into transition, but not specifically. I don't think today this is the most important thing for the typical affiliated of the funds that we manage.
All right, thank you so much. Ian, for you, what are the levers of action in the financial industry to fostering the energy transition? Can you give us your point of view?
Absolutely. So I think there's a lot of actions that we can take, but for me it really boils down to 5 things. The first one is meaningful engagement and voting. And there's 2 particular things to call out. It's not just about the companies that we hear about and that we go after, but it's about the broader value chain that these companies operate in. That's where some of the difficulties could lie. And the second one is a strong escalation strategy. We heard it just now, divestment, obviously at the very end, but we have to use our voice. We have to go up the ladder, not be shy, to use our vote in order to make our voice heard. And if all else fails, divestment needs to be an option. The second lever, in my opinion, is product evolution. We need to evolve our products. Again, twofold. On the one hand, we need to review the allocations that we have. As asset managers, as asset owners, our allocation towards the emerging markets is historically low, just simply because the investments that we have are generally on the lower risk side. And we know and we've heard that the financing gap is especially big when it comes to the emerging markets. Actually, if you look at the global north pension funds, on average, it's about 5% allocation towards emerging markets. So we need to work on shifting these allocations. The second component under the product evolution for me is the fact that obviously when we talk about the energy transition, we tend to talk about higher risk type of investments. We talk about venture capital, we talk about PE. You couple that with emerging markets, you end up with higher risk. This is where the famous blended finance comes into play. And we heard over the talks over the last couple of days that there are challenges, especially on the political side. We need to overcome them because blended finance needs to be part of the inventory that we put into clients' portfolios. The third pillar that I would mention out of the 5 is that we need to build awareness. We already heard that there's mispricing that's going on, but there's also a disconnect in the perceived risk when it comes to investments in emerging markets. I'll give you an example. Moody's in 2022 published the fact that actually when you look at infrastructure projects in Africa, the default rate was around 5.5%, versus in Western Europe, it stood at 5.9%. Going into it, this was not the perception that people have when they think about infrastructure projects. There's a secondary problem here. When we talk about Africa, but Africa has many different flavors, and we need to look at the individual regions that they are individually. Now, I grew up in Asia, and that was in the 1990s, and back then it was a similar story. Now you can't afford not to be invested in Asia. The fourth pillar is the fact that we essentially, we need to leverage the financial firepower that we have. Switzerland is the biggest cross-border wealth manager with $2.4 trillion in assets. We are an international leader when it comes to charitable foundations of over $100 billion of assets. That's a really strong foundation that we need to leverage and that we need to build on. And the fifth pillar, a really important one, is collaboration. We can't do it alone. We need to work together. We as an asset manager, we need to work with our institutional clients to understand their constraints and overcome those. We need to work with our private clients who are highly liquid. It's the next generation that's knocking on the door. They're looking for environmental and social impact and returns on top of the financial one. And most importantly, we need to work together. We need to have one single voice because that's the one that's loudest and that's going to make a change.
Thank you so much. Alex, maybe coming back to you. Do those levels resonate to you? Do you have any other additional comment?
Oh, of course they resonate. So many things that Jan have mentioned are part today of our investment process. Now, what I would say is the question is how much and how far do you go? Can we do more? Yes, we can do more. Should we do more? Yes, we should. Do more. But maybe just rebounding on the emerging markets example. Emerging markets in the equity space have been underperforming for a long time, 10 or accumulated probably 20 years. You look at the performance, underperforming. So in my seat, people, a lot of it is always first reaction is rear view finance is, oh, why should I invest there? This has been underperforming. As simple as that. Don't go any further. So pressure today is more, should we continue investing into emerging markets the way we did before? Or should we maybe not listen? This doesn't seem to work from a return perspective. So as simple as that, where you have to maybe fight or convince people for these kind of conclusions. Then on all the other things that were mentioned, maybe I'll take an example on the real estate approach we've taken. So on real estate, we are a big owner of direct real estate. If we want to have a good sustainable score on our real estate portfolio, we can do two things: sell all the bad assets or work on the assets to make them better. So we've chosen to work on the assets, on the buildings to make them better. So isolation, changing energy sources, which has a cost. So this will cost us. And in the short term, this will mean less return. So we've accepted that. And then, well, we'll see in the long run if the return maybe will be better than if we would not have done this. But in the short term, we invest, it costs, but we'll get a more sustainable real estate portfolio. Now, if I translate this to what I mainly work on, which are listed and unlisted investments on capital markets, well, it's not that easy because I can say, okay, I'll invest and maybe this might have a cost, but I don't know what the outcome will be. In real estate, you quite surely know what the outcome will be. You can, with some confidence, predict how much it will cost and how much energy you will save, or by how much you will improve the energy consumption. In all the capital flows that we've discussed is, with some degree of certainty, I will contribute, make the world more sustainable, contribute to transition, but don't really know what the financial return will be, or quite a big uncertainty there.
Mm-hmm. Thank you so much, Alex. Before we finish, we have, surprisingly, another couple of minutes, so I think I would like to deal and to actually go deeper in one of the points that both of you actually brought forward. Misconception about risk. You mentioned the case of Africa and some of the realized returns versus expected returns. Sometimes in finance, when we look at risk, we look at with the back mirror, right? You just look at the back. And now, do you think that this risk of the transition is well priced today in the market? I expect an answer. You're looking at me like very interested, but you would like to have an answer. Yes.
Sorry, what risk is correctly priced?
This climate risk, climate transition risk. I say that because if we just look at this, looking back, chances are that it's well priced and that this is it. But if you actually want to really look forward, 5 years, 10 years down the line, how do you feel about that?
Well, if I would take a stand today, I would say probably it's not correctly priced. So the risk is underestimated. That being said, so I can comment on what can I do. I can say, okay, I'll reduce the climate risks in my portfolio, and I'll have a strategy for doing this. And then time goes by, and after a few years, people will ask me, okay, well, you've reduced the climate risk. How has this helped our portfolio? Well, probably I won't have an answer then. It will take a real long time, if ever, to find out. And by the way, risk management, proving the added value of risk management is always complicated, even more for climate risk. Much easier for me to say, I've done this, I've invested there, this is the outcome. You can measure it, you can look at it. Yeah.
Thank you. Thank you.
Maybe I can add, and I'll make it quite specific. When we look at data, I think we have a fallacy to focus too much on backward-looking data. To your point, when we analyze a company, emissions is obviously a natural factor. The regulation has put it on the table. I mean, it's a hygiene factor. We need it, but that's not it, because you're looking at the past. I think it's about the plans that these companies have. It's about the investments that these companies are making, the capex that they're putting into their actual operations in order to improve them and make them future-proof, and we're not getting enough of that. Now, there are other metrics out there that are trying to really look at the future and try to make it simple, because it does get complex when you look at all the different factors plus assumptions that go in. That brings another level of difficulty, because an ITR that tells you the temperature of this company is this point this, that's a bit too specific potentially, so there's other risks embedded in that.
Absolutely. Thank you so much. And I think that concludes your intervention. Thank you so much for being here. And I think this deserves a round of applause. Thank you so much. And before we go, I would like to thank you so much, gentlemen. Thank you so much. And before we go, I would like to call Carla Della Maggiore to come here and join me. Carla is Deputy Director at BASE and is an international consultant focusing on climate change, mitigation, and adaptation, and climate finance. Thank you so much for being here, and I think this is yours.
Yeah, a couple of things. Microphones. So how do I move this?
Just for
the green one.
Yes.
Okay, perfect. So let me start here. So hi, good morning, everyone. Let me just go through these. So, okay, I want to start by asking you, about innovation. Innovation is key to achieve Switzerland's energy transformation. So if you had the chance to connect to Slido, I want you to answer this question. Where do you think innovation is most needed to achieve the goals of the energy transition? Are we talking about technology innovation? Are we talking about digital innovation? Are we talking about business model innovation or regulatory policy innovation? Okay? So, but even if you didn't have the chance, you may think about this, because this whole pitch is about connecting and talking. I don't know if we have any results, but otherwise I really want to keep moving, because what I want to say here is that all of these are relevant. Look, wow, this is music to my ears, as business model innovation is coming like the strongest one, because that's where I want to focus my talk. So if we can go back to the slides, or I have the power, it seems. Okay, so what do we mean by business model innovation? We mean enabling an ecosystem where actors collaborate, aligning their incentives, so at the end of the day, when they pursue their own goals, they achieve benefits for everyone, themselves, society, and the planet at large. So, what I want to say here is that business model innovation presents opportunities for investments, supports the building of green portfolios. And a very good example of this is the power purchase agreements that not only prompted the deployment of solar photovoltaics at scale globally, but also represents like $20 billion of investments and expected to grow up to $400 billion by early next decade. So, like power purchase agreements are a kind of as-a-service business model, or what we can call servitization. So in the servitization business model, what we have is that customers pay for the output or outcome instead of buying the equipment that generates that output or outcome. On the other hand, the service provider remains the owner of that equipment and is responsible for the operation and maintenance. The wonders of this is that this brings peace of mind to the customer because they can focus on the core business. They also can transfer the risk, the performance and operational risk to the service provider who is, one, is the expert on the technology. Also, now it has the incentive to provide a good service because otherwise it doesn't get paid. Really building a good relationship with the customer over time. This translates in predictable and continuous revenue streams, therefore, like becoming stronger and less vulnerable to economic cycles. Also, the model incentivizes now the providers to deploy remote monitoring because they want to optimize the use of the equipment. This data generated helps to improve maintenance practices, moving from corrective to preventive maintenance, for example. That results in increasing uptime of the equipment and extending the life expectancy of the equipment. Again, this results in higher revenues, but also in assets that can generate cash flow for over a longer period of time. All this translates at the end of the day in benefits to the planet. But if we want to scale this, we need investors. We need especially investors backing the service providers. Why? Because now they change the schedule of cash flow. Okay, so what's in here for like the investors? First of all, I already sort of said some points. The fact that now they can invest in sound investments for like by financing the service provider. Now that service provider, by aligning incentives, has like developed robust streams of revenue, so they are like stronger in better shape to be able to pay back the financiers. On the other hand, I talk about data generation. This data now can be used by the investors to validate how they're progressing towards the achievement of their like sustainability goals or commitments. So in this case, like I want to sort of mention a special case. What about like, and Alexander was here, these investors who are also asset owners and let's say buildings. Why do you want to invest in the equipment to like operate your building rather than maybe invest in the structures that will fund the deployment of the as a service? You can gain the benefits of the customer, of also as like as an investor. So what I'm saying here is that changing our mindset and the value of assets through servitization it has challenges. That's why we don't see it everywhere. So I would like to see, again, keep this in your mind. If you have the slide, or answer it. If not, think it, because again, this is a conversation. What do you see as major roadblocks in financing servitization, based on whatever I describe about the model? Again, if we have some result, this is an open question, so it's a little bit more tricky. But what I want to say is that there are challenges. We know that there are challenges. Okay? So it's not that we are denying that. But we want to invite you, let's talk. Let's talk so we can address these challenges, figure out what kind of mechanisms we can put in place so we engage the financing sector to give its potential, maximum potential into servitization. That is key. And this is especially a case. Why? Because Base Foundation, the organization they represent, together with E4S and with the support of the Fundación Valerie, is bringing the servitization model here to Switzerland. Let me introduce you to Servetia. It's an initiative to show the benefits of the model here in Switzerland in buildings. Buildings are key for decarbonization. They are responsible for 40% of the demand of energy and of 25% of the emissions. So we are engaging everyone, all the actors we mentioned. We already have a cluster of service providers interested. So this is a call to action for you. We need champions. So we invite customers and financiers interested to approach us. Scan the QR code, check our website, and learn what we are doing. In addition, two of my colleagues who are leading the Servetia initiative are here, so they are like more than willing and open to talk to you. Thank you.
Thank you so much. Thank you so much, Carla. It's been really insightful. So hopefully you're seeing where we are going, right? You know, at the beginning, Jean-Pierre and Florence actually introduced what the issue is, right? What the big issue is about. Then after that, we had the gentleman actually join me, and really Alex and Ian, and really talking about what are, from the banking point of view, from the financial point of view, what are the constraints, so to speak. And now we go directly to the possible solutions, so to speak. One of these was actually exactly what the lead just before me was talking about. And now we have a new speaker, Philip Bernstein, and he's going to be basically giving us another piece of the puzzle, how to address all this. Thank you so much, and you have 5 minutes.
Fantastic. Thank you so much.
I'm watching.
Great. Need to be closely watched, of course. I'd actually like to start by saying that, as the title here suggests, that climate change is a financial problem. I think we can all agree on that. But there isn't that there is a lack of capital in the market, but rather a redirection and a reallocation of the capital that's in the market. So I would like you to imagine a world without greenwashing, where you as an investor know exactly, down to the cent, where your money has been deployed and what type of financial and environmental impact that it is having. And that's where Frigg enters in. So Frigg, we built a regulatory compliance software for connecting project SPVs, so really hardcore infrastructure projects, with investors directly, solving some of the inherent problems, as we could see before, for investors related to illiquidity, transparency, and issue of scale. And obviously, we do leverage here blockchain technology to unlock these benefits. But the question immediately becomes, and as all the academics in the room will testify to, there is very little hard data as to what investors are willing to pay for these benefits. And that's why, together with E4S, we established a questionnaire where we're trying to address the community and ask them the questions. So I would kindly ask you to scan the QR code and provide your inputs, because the first question relates to accessibility. What are you, as investors, willing to pay or forego in performance to get access to these kind of deals? It for sure has a premium, because currently it's not that accessible. But the question is how much? So I'll pause here for 10 seconds and let's see if some results come in. So assume that the base return of an asset would be 3%, and you would basically account for the premium that you would pay to get access, and what that would be. And as the result starts to come in, I can move on to the next slide. And if there aren't any, then I guess the question was confusing. Good, so I'll keep on going. So let's assume that you do have access to these kind of investments. Then obviously you would like to know, okay, what type of information can I get? And I think I jumped actually 1 or 2 slides ahead here. Apologies for that. So the next topic then is, what type of information would you like to assess? There we go. So now you have access. So you can get into the project itself and read about who's behind, who has originally financed it, or the co-financiers who are buying into it, where it is based. Might be also web cameras associated with it. It obviously tracks operational performance, so you would know how much electricity is produced at any given time. Also the associated carbon avoidance. This is all possible through IoT technology and embedding that into the security that is on offer. And then the second question then arises, what would you be willing to pay for this kind of transparency? I mean, today it's unheard of, right? I mean, how many of you own hydropower facilities? I guess very few. It sits with financial intermediaries, and they charge a premium for that. But you as end investors, what would you be willing to pay for this transparency? It has a premium. The question is how much? So the second question here relates to, given a base return, how much would you be willing to pay? Again, here your return goes down to a certain premium. And you would get access to this information. Okay, so there is some interest. There is a small premium there. And that's great to see. Right. So now the third topic actually, and that should matter because that relates to illiquidity. Now imagine you buy into these assets. In the traditional world, there is what's called a lockup period. So normally you need to hold these assets for a long time before you can start to divest. If you look at data, it's roughly between 5 to 10 years of these kind of infrastructure assets. So it's a long holding period. And normally that has a premium. And it's what's called the illiquidity premium. But if you could trade it almost in real time with the information available, because as the power plant produces electricity, the revenue stream is volatile, so it obviously has an impact on the value of the asset. So it should change over time. Then the question becomes, what would you be willing to put as a price on the illiquidity? And I know the answer from literature, but it would be interesting to see what the people in the audience would guess. So I see I'm slowly running out of time. Please, if you have any answers to this. Okay, my return goes down. So you're willing to pay 10 bips. Interesting. In literature, would you have a guess at what it is? It's almost 100%, doubling the premium. So this is an interesting artifact, and this is what we're working on at Frigg, and building basically an institutional-grade platform on what you saw before, which was our proof of concept launched end of last year. Thank you for your attention, and looking forward to the questions.
Thank you so much. And what do we have next? I think we have a couple of slides. Absolutely. So thank you so much for this insightful presentation and for a way of actually putting data and getting prices, right? We like prices. While in finance we do like prices, we like to understand what prices of each features are about. What is going to be happening next is really a really interesting story about something which is not present to our eyes most of the time. And I would like to invite you, please come here, interpret, to tell the stories about your venture and about Azura Power. Okay? Thank you so much for being here.
Thank you. This is the one.
This is forward.
Great.
Yes.
So I built a company called Azura Power over a 12-year period, providing solar energy as a service to utility, to private, to residential customers in India. And that story resonates with the topic of the day in terms of finance being a critical aspect for infrastructure. I've heard the word risk in emerging markets, risks in contracts, non-availability of capital, all these challenges I faced. And interestingly enough, just to put things in perspective, I developed about 5,000 megawatts of projects over a 12-year period that required about 10,000 hectares of land, 100 kilometers of transmission infrastructure, and millions of solar panels. That's probably about the same amount of solar energy you have in all of Switzerland today. So that's what I built in an emerging market. Thank you. Sometimes, it's overwhelming even for me to speak about it. And when I started, it took me 2 years to raise the capital for the first megawatt. It was actually the first megawatt project to be built in India with solar energy. And it was about financing of about $5 million. The last funding I did was a public bond for $500 million in 30 days. So the first and the foremost thing I had to do was to make sure align the incentives of all the stakeholders. So you need very strong contracts. You need very strong credit. You need to eliminate risks of technology. You have to use proven technology. You have to find counterparties who are willing to pay you over a long period of time. You heard earlier Carla talk about, Servetization and how do you create cash flows for investors over a long period of time. So I had to spend like 2 years in building that contract that an investor would be willing to fund. So once you have a very strong contract, you have a very strong credit. So we found the best credit in the country. So you work with the policy stakeholders. You tell the government of India, if you want to attract foreign investment into this sector, you put your best foot forward. Now, best foot forward doesn't mean concessionalize, give grants, give free money. Give the best purchaser of the contract. So the largest coal power company in India decided to buy solar power because they had the strongest balance sheet. That would give you a BBB, rating on the bond. So that is what foreign investors would invest in. So get the best credit. Then what do? Then you try to find different classes of capital. So you need to put your equity in, but use as little equity as possible for development of the project. Get the project to the construction stage. Then you get the construction finance institutions who are only interested in a 12 to 18-month finance at a higher rate because the risk is high whether the project will be built or not. Then you get into pension fund, then you get into project finance for the longest possible tenor so you can lower the price of electricity for the customer because the customers are not willing to pay the premium. And we've heard this in the earlier sessions. The investors or the customers have 20 different choices and they are not willing to pay the premium. Some maybe, but most are not. So you have to provide a financially viable solution for all the stakeholders in the entire ecosystem. So the way we did it is we started with a little bit of equity to start the development. Project is developed, then you get long-term construction finance for 12 to 18 months, then you get even longer term, 12 to 13 year of financing, and then you get into public bonds. So your tenors increase on financing, your cost decreases, and your returns go up. All my investors, equity investors, were paid off at the IPO of the company. The debt investors were paid off at the bond listings of the company. So ultimately, for a success of transition of energy projects, you need to tap public equity, you need to tap public bonds, you need to tap pension money, you need to tap insurance money, and for that you need scale. So that's, I think, the learnings that I have had from 12 years of building that business. Now, then what I decided to do after I learned the hard lessons, I realized that most companies remain to be small and not large. Because, interestingly enough, larger investors, larger capital pool only chases large infrastructure companies. So there is very little room or very challenging for small companies to become big companies. So I put together this bubble chart of the different companies in size and scale. So the longer track record you have, the greater your balance sheet is, the lower your cost of finance is. But what do small companies do? So I ventured on with my next company called Climb Finance, where we are trying to be the bank for smaller companies. And rather than underwriting companies, we are underwriting smaller projects with the same sophistication of larger projects. So that is the change we are trying to bring in. And we've launched for about a year. We've had great success. The smallest transactions we've done is $12,000. And the largest transactions we've done is $2 million. But these are the kind of transactions in financing with competitive rates are not present in the country today. So that's the next venture that I have. In a few years, we'll see where we go with that. Thank you so much for the time. Great. So we'll continue this dialogue with a fireside chat, and I would like to invite Philippe and Carla up on the stage. So maybe you don't need any introduction, everybody knows you. I'd like to start, thinking about servetization. There are many actors, there are many different interests, there are a lot of misalignments. How do you see the challenges in bringing some incentives or bringing the alignment among the different actors to make innovation successful?
Absolutely. I think you touched upon that because you have been in the servitization business. And when I talk about enabling these ecosystems, we're specifically talking about developing sort of financial and non-financial mechanisms that allow us to make those changes. One of them could be contracts. But I would even go to some basic stuff. We're talking about a main challenge here is change of mindsets. And let me talk about these three actors that I showed. One were the customers, the service providers, and the investors. First of all, customers. You talk to some of them, and they're accustomed to own things. And they are afraid of letting that ownership go because they feel that maybe they can manage better. But if they realize that there's someone who's going to be more expert on that, you can change that mindset. And the best way to do it is to showcasing examples. We have launched several initiatives around the world on the as-a-service business model, and we have a really good network. And our partners are showing how this is doable and the benefits that they are achieving, not just for themselves, but for the customer. This peace of mind that I mentioned is key. So when you say to someone, look, this is going to bring you peace of mind, and in addition to that, you can, deploy your capital to your core investment, etc., they are happy with that. So bring in the cases. In the case of the service provider, one of the also lessons maybe from our partners is that when you want to bring something innovative into a culture that's already there, maybe try to do it in parallel. Why? Because you really need to start changing the way they are even evaluated. The performance of a salesperson is to sell. So they are measured by the number of units that they sell. So when you're telling them, now you're not going to be selling any more units, you're going to be building relationship with your customers. Can they really adapt? It's going to depend on the size of the company. And then in terms of the investors, we did talk about, I love the example that you gave, is recognizing that there are different roles throughout this sort of building up of the financing process. But again, I would like to see more engagement, understanding how they can start collaborating among themselves, so at the end it's a more tailor-made solution and not just someone going and knock door by door. So that's key. And I did mention before this possibility of that asset owner to become also the investor. So start thinking of okay, I'm doing something. If you are putting the money in a way that's going to be more effective and you're going to get a better result, I think open your mind to that. And again, a call for innovation, so a call to you who are here. And something that is key, as you said, supporting the industry and policy development is what's going to really make this ecosystem stronger.
Thank you. So Philippe, the infrastructure projects are loved by large investors, large projects, and I know Frigg is trying to solve the problem for financing smaller infrastructure projects. What challenges do you see from the industry and the policy side in your business today? And what are some of the things that can be done either on the policy side or in the industry to help you unlock the potential of small project finance?
So the short answer, a lot. I think we're fortunately based in Switzerland from a regulatory perspective because we're building in a field that is still very nascent. The Swiss DLT bill got passed in February 2021, which obviously was a big benefit for us building in this space. But still, from a regulatory side, I think a lot of things can further improve. And we feel that when we talk to, because we're building a B2B model, we feel that a lot with the financial intermediaries, actually. There is still a lot of hesitancy and risk And actually, we talked to this this one bank, and that was funny. I'm not going to mention name, but they were building, in their view, what would be a sustainable crypto product or blockchain product. And we asked them about, okay, so how does this product look like? Yeah, well, we're basically creating a fund where we bucket cryptocurrencies, but we exclude the ones that are not environmentally friendly. And we thought, okay, great, but there is also another application of the technology that you allude to, and that is, why not use the technology to unlock real-world assets that actually has a climate-positive benefit and effect? Because cryptocurrencies certainly do not. I mean, it's just a means of payment. So what do you do with these payments? They need to create value somehow. And that value is created by real-world assets. So the question becomes, how do you bridge that gap of really that non-listed nature and non-accessibility currently? Because everything below $100 million in CapEx is not touched upon by the financial players in the market currently. And they're too large to carry from a retail investor community because you need rigid due diligence processes, you need a credit rating, creditworthiness of the project itself. And retail investors aren't at the stage where they can do that assessment in their isolation. And obviously, that's also where regulation comes in to protect them. And that's how it should be. But still, we could leverage the technology to bridge the gap. But there is still a lot of resistancy and uncertainty as to what is going to happen for the bank if they hold, let's say, digital assets, tokenized assets, on their own balance sheet. For cryptocurrencies, it's quite hefty. If they would do so, it's 8 times the current value of the crypto assets that they're holding. They need to hold cash. And that's not going to work. And that's why they're creating structured products where they're keeping it off balance sheet and still having it as an option to investors. But the investors that we're looking for, they're still in the traditional market, but we're just using the technology to enable broader access. So yeah, long answer, but a short and a long answer to that question.
Thank you. If I may ask like a final question to both of you, and see if I get the same answers or different answers. One of the things that I believe is about changing behavior to do this transition. What are your thoughts on how to deal with the personality side or change in behavior side, which may not be based on the data that you're looking at? How would you go about dealing with that challenge? Maybe with you, Carla, first.
I would say that is quite challenging because it's about, like, as I said, the change in mindset. And I would say try to, I don't know, figure out what are the pain points of the person you have in front. And when we talk, maybe we're very familiar with the terms that we're using. Maybe Philip is more familiar with the blockchain than I am, but still, like when we talk about energy efficiency, climate investments, like climate returns, et cetera, for some people, even like builder owners that I'm really trying to target here, they don't talk that language. They can be talking the language of a school, they can be talking the language of a hotel, etc. So try to bring onto the stage, first of all, very simple terms, and then try to really, how that these address something that they're really interested in, beyond the financials. So I would say that's, maybe it's like simple, but I say it's a starting point for you to develop that.
It's definitely a challenge, and especially, again, coming from an innovative way and trying to not disrupt, but trying to really improve, not marginally, but drastically, the way we do things. It's a big gap, and it goes across not knowledge only, but also generation and regions, and trying to manage that complexity is difficult. But there is, I feel definitely a willingness to change, and if we can start from the fundamentals, which we truly see, like project developers, and spoken to Carla a lot about this, and the appetite for innovation on that side is definitely much greater than the appetite on the other side. But I think in that way we could almost like bootstrap, because in the sense we're all looking for access to the same things, and if you can ring fence one side, you're already coming very far away. So we're seeing a lot of change, but it's very slow. And as a startup, that's obviously challenging when you need to balance out burn rate. But I think we're getting there, and it's good to see also with the generation shift that is coming.
Great. Well, thank you so much for your kind words, and I wish both of you a lot more success in your endeavors in servitization and transition of energy.
Thank you.
Thank you.
Thank you so much, Interpret, for this fantastic story, and also to you guys, Carla and Philip, for your insights on that. We're almost at the end of this very quick session. There's something missing. We have one stakeholder which is missing, which is basically the regulator, and actually that actually came out a little bit from the discussion that we had before. I would like to call Christoph. All right? Voila, here, Christoph Baumann. And thank you so much for being here. And maybe tell us a little bit about your story.
I don't have slides.
Don't have slides. All right.
Sure. Well, thank you very much. It was super interesting to listen to all these interesting presentations and the solutions. I first of all would also commend Florence for some of the remarks, or for all of the remarks she said at the beginning. But one of the things which stuck out for me is the clear language on exclusion. How can you have, and I'm quite sick of or tired of people saying exclusion has no role in the transition. How can you have a successful engagement strategy without the stick in the hand, the ultimate escalation strategy of excluding? And also, you mentioned the market the price signal and the stigma you create through that. I'm very confident that managers are looking at the share price. Bravo to you on that side. So let me make a very short closing remark and reiterate that we're in the decade of action. And we have all the mandates on all the different levels to act. We have the Paris Agreement, 2.1c, aligning financial flows with the goals of the Paris Agreement. We have, since last year, the Kunming-Montreal Global Biodiversity Framework, Target 14, aligning financial flows with biodiversity goals. We have the Climate and Innovation Law in Switzerland, the first country in the world where the population voted with over 60% for the net zero and all target in 2050, and also for aligning financial flows, giving us the mandate to do so. So we're in the decade of action, but action requires decision-useful information, and there technology plays a crucial role, both in sourcing the information, in making the information better quality, and in building solutions on top of this information, as we've seen today as well. And whenever humanity is with its back against the wall, innovation tends to strive. But we cannot hope, we don't have the time to just hope and that this will be to a sufficiently degree now the case as well with climate change and with biodiversity loss. We need to create actively the framework conditions for innovation to strive. So here the government plays a key role, in my opinion. One of the areas we are working on that is really to establish disclosures on the key topics on climate based on TCFD and now ISSB, on nature with the TNFD launch, but also on social issues and other issues relevant for this transition. So that's one of the key aspects. The other thing, I think it was mentioned as well, is we need to create clarity in the market, what actually has an impact, which investment has an impact. So the work on greenwashing is absolutely key to ensure that when you want to have a contribution as an investor, that you can have a credible contribution. And the third aspect I believe is key is we need to help startups strive. So we need to get them together, we need to connect them with capital, we need to find ways to scale them, so to connect them also with larger corporations. On the financial sector side, this is why we created the Green FinTech Network 2-3 years ago, which now has become its own association, not just with the Green FinTechs in there, but also with stakeholders such as EY, UBS joined yesterday, so it's absolutely key to drive this forward, and the government can play a key facilitating role in this. So to reiterate, we're in a decade of action, and it's almost 2024, so let's get it going.
Thank you so much. Thank you so much, Christoph, and thank you so much actually to all the people actually participated and contributed to this panel. Thank you so much also Florence and Julia to put this together. At the end of the day, really, some years ago, many years ago, I was much younger, and I bought this book, and it was a great book, and the title was Art Finance: The Art of Making Things Happen. They didn't sell that many copies, okay? I don't think that the name was very cool and very sexy, But I think at the end of the day, I really believe that we have a responsibility in finance, and our responsibility this time, more than any other time in history, is like to make things happen. All right. So thank you so much for those of you actually that are like really driving this transformation. For the first time, actually, I really believe that the role of the regulator is very much in line. We're talking about transparency. We're talking about clarity. We talk about help startups actually to thrive. I think there's very much alignment between what private sector would like to have and what the government and what the regulator would like to have. Thank you so much for your attention. I think there's a lot of material for you to think and to re-elaborate in time. And good luck with the rest of the journey over here at this conference. Thank you so much.